The average American will earn somewhere between $1.5 and $2 million over their working lifetime. Most of them will retire with almost nothing. According to Federal Reserve data, the median retirement savings for American households approaching retirement age sits around $87,000. That's roughly 3 to 4 years of expenses, maybe 5 if you're frugal. Meanwhile, a different group of Americans, those who understood what I'm about to explain, will retire with portfolios worth 10 times, 20 times, even 50 times more than that median figure. These aren't people who earned dramatically higher salaries or inherited family wealth. Most of them never got lucky picking the next big stock. They simply understood how the game actually works, they started early, and they stayed consistent. The difference between those two outcomes often comes down to a single decision made in your 20s, 30s, or even 40s. The decision to actually begin. If I were starting from zero in 2026 with no investing knowledge, no financial background, and no family wealth to rely on, this is exactly what I would do. Step by step, account by account, dollar by dollar. By the end of this, you'll understand not just what to invest in, but why. You'll know which account to open first and the exact mental frameworks that will keep you invested when markets inevitably drop and every headline screams that the sky is falling. This is the video I wish existed when I started. It's the foundation that everything else builds upon. Take notes if you can. Let's begin with the most important question. Why do we invest at all? There are 2 fundamental reasons, and understanding them deeply will carry you through every market crash, every period of doubt, and every temptation to do something foolish with your money. Reason number 1, inflation is silently destroying your purchasing power every single day. As of January 2026, inflation in the United States sits at 2.4% annually. That's actually relatively tame by recent standards. We saw inflation spike above 9% in 2022. The Federal Reserve targets roughly 2% inflation as their goal for a healthy economy. But even at 2%, your money is losing value constantly. Think about what this actually means. If you have $50,000 sitting in a checking account earning essentially zero interest, that money loses approximately $1,000 of purchasing power every single year. Nobody stole it. You didn't spend it. The prices of everything around you simply increased while your pile of dollars stayed the same size. Over a decade at 2% inflation, your $50,000 buys only what $41,000 would have bought when you started. Over 2 decades, it buys what $33,000 would have bought. Over 3 decades, an average working career, your $50,000 has the purchasing power of roughly $27,000. You lost almost half your wealth to inflation without spending a single dollar. This is why keeping large sums in checking or savings accounts for extended periods is one of the worst financial decisions you can make. The interest rates on most savings accounts, even high-yield ones, barely keep pace with inflation. At best, you're treading water. At worst, you're slowly drowning. But here's the counterpoint. And this brings us to reason number 2. The stock market, over long periods, has returned approximately 10% annually before inflation and roughly 7% after inflation. That 7% real return doesn't just beat inflation, it compounds. And compound growth is the single most powerful wealth-building force available to ordinary people. Consider 2 scenarios. Scenario 1. You put $500 per month into a savings account earning 4% annually. After 30 years, you'll have approximately $346,000. You contributed $180,000 over that period, so you earned $166,000 in interest. Decent, but nothing extraordinary. Scenario 2. You put the same $500 per month into a diversified stock portfolio, earning the historical average of 10% annually. After 30 years, you'll have approximately $1.1 million. You contributed the same $180,000, but you earned over $900,000 in growth. Same monthly contribution, same time frame. 3 times the result. That gap comes entirely from the difference between 4% and 10% compounding over time. At 10%, your money doubles roughly every 7 years. At 4%, it takes about 18 years. This is why we invest. The alternative, letting inflation erode our savings while we watch from the sidelines, is guaranteed wealth destruction. Compound growth is the only legal way for ordinary people to turn modest regular contributions into life-changing wealth. Time is our greatest asset, and every year we delay costs us exponentially more than we realize. Now that we understand why, let's talk about what. Why stocks specifically? Why not real estate, gold, cryptocurrency, art, or any of the countless other things people invest in? Stocks have 3 characteristics that make them ideal for most investors. First, stocks are liquid. When an investment is liquid, you can convert it to cash quickly and easily without significant loss. If you own a rental property worth $400,000 and you need that money next week, you're in trouble. You'd have to list the property, find a buyer, negotiate, go through inspections and appraisals, handle legal paperwork, and wait for closing. That process takes months at minimum. And if you're in a hurry, you'll likely accept less than market value. If you own $400,000 in an S&P 500 index fund and you need money next week, you press a button. The shares sell in seconds. The cash hits your account within days. This liquidity doesn't mean you should treat your investments like a checking account. We'll discuss why shortly. But it does mean that in a genuine emergency, your money is accessible. That flexibility has enormous value. Second, stocks are accessible. Buying stocks requires no real estate license, no negotiations with sellers, no property inspections, and no 6-figure down payment. You can open a brokerage account in 15 minutes, deposit $100, and own a piece of the largest, most profitable companies on earth. You can do this from your phone while sitting on your couch. In 2026, most major brokerages, Fidelity, Schwab, Robinhood, Vanguard, charge 0 commissions on stock and ETF trades. Many allow you to buy fractional shares, meaning you don't need $500 to buy a single share of a company. You can buy $50 worth or even $5 worth. The barriers to entry have never been lower. Third, stocks have reliably produced strong returns over long periods. This is the critical point that requires nuance. Over short periods, months, a year, even several years, stock returns are highly unpredictable. The market dropped 34% in 5 weeks during March 2020. It dropped 57% over 17 months during the 2008 financial crisis. It dropped 49% over 2.5 years after the dot-com bubble burst in 2000. But over long periods, 15 years, 20 years, 30 years, the stock market has never failed to recover and reach new highs. The S&P 500, which tracks the 500 largest publicly traded companies in the United States, has produced average annual returns of approximately 10% since its inception. Over the past 30 years, through December 2025, that figure comes to approximately 10.3% annually. Over the past 50 years, approximately 12% annually. Over the past 150 years, approximately 9.5% annually. Different measurement periods produce slightly different numbers, but the pattern is consistent. Patient long-term investors have been rewarded. No other liquid, accessible asset class has matched this track record. Real estate can produce strong returns, but requires active management, significant capital, geographic concentration, and illiquidity. Bonds provide stability, but historically return only 4 to 6% annually. Gold preserves purchasing power, but doesn't compound. It produces no dividends or earnings growth. Cryptocurrency is too volatile and too new to have a reliable long-term track record. Stocks aren't perfect, but for most people building wealth over decades, they're the optimal choice. Now let's discuss how to actually buy stocks. You need what's called a brokerage account. This is like a bank account, but instead of just holding cash, it allows you to purchase and hold investments, stocks, bonds, ETFs, and other securities. Brokerage accounts come in 2 main varieties: retirement accounts, and regular taxable brokerage accounts. Understanding the difference is critical because the type of account you use matters almost as much as what you invest in. Retirement accounts include 401s, IRAs, Roth IRAs, 403s, and a few others. Their defining characteristic is special tax treatment from the IRS. With a traditional 401k or traditional IRA, you contribute pre-tax dollars. If you earn $70,000 and contribute $7,000 to your traditional IRA, you only pay income tax on $63,000. Your contribution reduces your taxable income immediately. The investments grow tax-deferred, meaning you don't pay taxes on dividends or capital gains each year. You only pay taxes when you withdraw the money in retirement. With a Roth 401k or Roth IRA, you contribute after-tax dollars. Your $7,000 contribution doesn't reduce your taxable income this year, but the investments grow tax-free. And when you withdraw in retirement, you pay nothing. Zero taxes on decades of growth. The trade-off for these tax advantages is that retirement accounts are designed for retirement. If you withdraw money before age 59 and a half, you'll typically face income taxes plus a 10% penalty on traditional accounts. Roth accounts are more flexible. You can always withdraw your contributions penalty-free, but withdrawing earnings early triggers penalties. For 2026, the IRS has set the following contribution limits. 401k plans allow you to contribute up to $24,500 per year. If you're age 50 or older, you can contribute an additional $8,000 as a catch-up contribution for a total of $32,500. If you're between ages 60 and 63, you can contribute an even higher catch-up of $11,250 for a total of $35,750. There's also a new rule starting in 2026. If you earned more than $150,000 in the prior year, any catch-up contributions you make must be designated as Roth contributions. They must be made with after-tax dollars. IRAs allow you to contribute up to $7,500 per year in 2026, up from $7,000 last year. If you're age 50 or older, you can contribute an additional $1,100 as a catch-up contribution for a total of $8,600. Roth IRA contributions have income limits. For 2026, single filers begin losing eligibility to contribute at $153,000 of income and are completely phased out at $168,000. For married couples filing jointly, the phase-out range is $242,000 to $252,000. If you have a high-deductible health insurance plan, you may also have access to a health savings account, or HSA. While technically a healthcare account, HSAs function as excellent investment vehicles. For 2026, you can contribute up to $4,400 for self-only coverage or $8,750 for family coverage. If you're 55 or older, add another $1,000. Starting in 2026, bronze and catastrophic health plans from the marketplace are now HSA compatible, expanding eligibility significantly. HSAs offer what's called triple tax advantage. Contributions are tax deductible, growth is tax-free, and withdrawals for qualified medical expenses are tax-free. If you're healthy and can afford to pay current medical expenses out of pocket, you can let your HSA investments compound for decades and withdraw tax-free in retirement for healthcare costs. Regular taxable brokerage accounts have no contribution limits and no withdrawal penalties. You can put in as much as you want, whenever you want, and take it out whenever you want. The trade-off is less favorable tax treatment. When investments in a taxable account pay dividends, you owe taxes that year. When you sell investments at a profit, you owe capital gains taxes. Long-term capital gains on investments held more than a year are taxed at preferential rates of 0, 15, or 20% depending on your income. Short-term gains are taxed as ordinary income. So where should you actually open these accounts? For most people in 2026, I'd recommend one of 4 brokerages: Fidelity, Schwab, Vanguard, or, for a more modern, mobile-first experience, Robinhood. Fidelity and Schwab offer excellent platforms with 0 commissions, 0 account minimums, fractional share trading, strong customer service, and access to essentially every investment you'd want. Both have physical branches if you prefer in-person service. Vanguard pioneered low-cost index fund investing and remains a powerhouse, though their user interface is notoriously dated. If you can tolerate a less polished experience, their funds and philosophy are excellent. Robinhood offers the cleanest mobile experience and has successfully brought many younger investors into the market. Their platform now offers IRA accounts with a match program that effectively gives you free money for contributing. All 4 are SIPC insured, meaning your securities are protected up to $500,000 if the brokerage fails. All 4 offer the core functionality you need. Pick one. Open an account. Don't overthink this decision. Now we reach the most important question. What should you actually buy? You could buy individual stocks, shares of specific companies like Apple, Microsoft, Nvidia, Tesla, or Amazon. And some people do build wealth this way. But buying individual stocks requires significant research, carries concentrated risk, and produces outcomes that vary wildly. For every person who bought Nvidia in 2019 and watched it increase tenfold, another person bought Intel at its peak in 2000 and still hasn't recovered their investment 26 years later. The data on individual stock picking is discouraging. Multiple studies have shown that the majority of actively managed funds run by professional investors with teams of analysts underperform simple index funds over periods of 10 years or more. If professionals with unlimited resources can't consistently beat the market, what chance do you have researching stocks in your spare time? This brings us to index funds and ETFs. An index fund is a type of mutual fund that doesn't try to beat the market. Instead, it simply owns all the stocks in a particular market index, like the S&P 500, in proportion to their size. An ETF, or exchange-traded fund, works similarly, but trades on exchanges like individual stocks. You can buy and sell ETFs throughout the trading day at whatever price they're trading for. For practical purposes, index funds and ETFs that track the same index produce nearly identical results. The main differences are in trading mechanics and sometimes small cost differences. The beauty of index funds is their simplicity and diversification. When you buy a single share of an S&P 500 index fund, you're instantly owning pieces of 500 of the largest American companies. You own Apple, Microsoft, Amazon, Google, Meta, Berkshire Hathaway, Johnson & Johnson, JP Morgan Chase, and 492 others, all in one purchase. If any single company fails completely, your portfolio barely notices. If a sector struggles, say banking or energy, other sectors pick up the slack. Your success doesn't depend on picking winners. It depends on the entire American economy continuing to grow, which it has done reliably for over a century. And because index funds don't employ armies of analysts trying to beat the market, their fees are microscopic. The expense ratio tells you what percentage of your investment the fund takes annually to cover its operating costs. Actively managed mutual funds often charge expense ratios between 0.5% and 1.5%. That might sound small, but over decades, it compounds into staggering amounts. If you invest $500 monthly for 30 years at 10% returns with a 1% expense ratio, you end up with approximately $900,000. The same investment with a 0.03% expense ratio, what the lowest cost S&P 500 ETFs charge, produces approximately $1.1 million. That 0.97% annual difference costs you roughly $200,000 over your investing lifetime. So which specific funds should you buy? For S&P 500 exposure, you have several excellent choices. VOO, the Vanguard S&P 500 ETF, charges an expense ratio of 0.03%. It manages hundreds of billions in assets and tracks the S&P 500 with minimal tracking error. IVV, the iShares Core S&P 500 ETF, also charges 0.03%. It's managed by BlackRock, the world's largest asset manager, and has similar characteristics to VOO. SPLG, the SPDR Portfolio S&P 500 ETF, charges 0.02%, the lowest of any S&P 500 fund in 2026. For purely cost-conscious investors, this is the optimal choice. SPY, the original S&P 500 ETF launched in 1993, charges 0.0945%. It's 3 times more expensive than VOO or IVV, but has the highest trading volume, making it popular among active traders. For buy and hold investors, the higher cost makes it suboptimal. Any of these will produce virtually identical results. VOO and IVV have the best combination of low cost and high liquidity. SPLG has the absolute lowest cost. Pick one and move on. If you want broader diversification than just the S&P 500, consider total market funds. VTI, the Vanguard Total Stock Market ETF, owns essentially every publicly traded company in America, not just the largest 500, but small cap and mid cap companies too. Approximately 3,600 stocks total. The expense ratio is 0.03%. ITOT, the iShares Core S&P Total U.S. Stock Market ETF, provides similar exposure at 0.03%. The performance difference between total market funds and S&P 500 funds is typically small because the S&P 500 companies dominate total market funds by weight. But total market funds provide slightly more diversification. For international exposure, consider VXUS, the Vanguard Total International Stock ETF, which owns stocks from developed and emerging markets outside the United States at 0.07% expense ratio. A simple but highly effective portfolio might be 60% VTI, 20% VXUS, and 20% BND, a total bond market fund. Or even simpler, 100% VTI or 100% VOO, while you're young and have decades until retirement. Complexity is not correlated with returns. The simplest portfolios often outperform complicated ones because they're easier to stick with. Now let's discuss when and how much to invest. Many beginners worry about timing. They see all-time highs in the market and assume they should wait for a pullback. They hear about potential recessions, elections, geopolitical tensions, or Federal Reserve decisions and think they should sit on the sidelines until things settle down. This impulse is natural but counterproductive. Here's a fact that might surprise you. The S&P 500 spends roughly 8% of all trading days at all-time highs. That's approximately 20 days per year when the market has never been higher. And research shows that buying at all-time highs produces essentially the same long-term returns as buying at any other time. Why? Markets that reach all-time highs tend to keep reaching new all-time highs. The trajectory of long-term stock prices is upward. Waiting for the right time to invest usually means missing the gains that happen while you're waiting. Nick Maggiulli, author of Just Keep Buying, analyzed decades of market data and found that investing immediately, even at market peaks, outperforms waiting for dips approximately 2/3 of the time. The reason is simple. Markets go up more often than they go down, so time in the market beats timing the market. But here's what makes this psychologically difficult. If you invest a large sum today and the market drops 20% tomorrow, you'll feel terrible. You'll question your decision. You'll be tempted to sell at the bottom and lock in losses. This is where dollar cost averaging becomes valuable, not because it's mathematically optimal, but because it's psychologically sustainable. Dollar cost averaging means investing a fixed amount at regular intervals, regardless of market conditions. Instead of investing $12,000 all at once, you invest $1,000 per month for 12 months. Instead of investing $6,000 annually, you invest $500 monthly. When prices are high, your fixed contribution buys fewer shares. When prices are low, it buys more shares. Over time, you acquire shares at an average cost that smooths out the volatility. More importantly, dollar cost averaging removes the decision from each investment. You're not asking yourself whether today is a good day to invest. The answer is always yes, because today is the day your automatic transfer hits. This automation is crucial. The investors who build the most wealth aren't the ones who make the best individual decisions. They're the ones who make investing so automatic that they don't have to decide at all. Set up automatic transfers from your checking account to your brokerage account. Set up automatic purchases of your chosen index fund. Then forget about it. Check your accounts quarterly or annually. Not daily, not weekly. Each time you look, you're tempted to tinker. Each time you tinker, you risk making an emotional decision that hurts your returns. The best investors are often the ones who forget they have a brokerage account. How much should you invest? The honest answer is as much as you can sustainably afford. Financial advisors often suggest saving 15 to 20% of your income for retirement. That's a reasonable target if you start in your 20s. If you start later, you'll need higher percentages to reach the same goals. But here's a more useful framework. Invest whatever amount allows you to continue investing consistently for decades. If investing $1,000 per month strains your budget so much that you miss payments after 3 months and give up, you're worse off than if you had invested $300 per month consistently for 30 years. Start where you are. If that's $50 per month, start there. Increase your contributions each time you get a raise. Each time you pay off a debt, redirect that payment to investments. Each time you receive a windfall, a bonus, a tax refund, an inheritance, invest it immediately rather than letting it sit in checking where it's easy to spend. The specific amount matters less than the consistency. $200 per month for 30 years at 10% produces approximately $450,000. $500 per month produces approximately $1.1 million. $1,000 per month produces approximately $2.3 million. Find your number, automate it, increase it over time. Now let's address the psychology, because this is where most investors fail. The historical average return of 10% is not what you'll experience in any given year. Some years you'll be up 25%, other years you'll be down 20%. Many years you'll be somewhere in between. Since 1928, the S&P 500 has delivered positive returns in approximately 73% of calendar years. That means roughly 1 in 4 years you'll end with less money than you started. Can you handle that? In 2022, the S&P 500 dropped approximately 19%. A portfolio worth $100,000 at the start of the year was worth $81,000 at the end. Many investors panicked and sold at the bottom, locking in their losses permanently. In 2008 and early 2009, the market dropped over 50% from peak to trough. A $1 million portfolio became a $500,000 portfolio. Some investors sold everything at the bottom and never reinvested, missing the subsequent bull market that pushed that same index up over 500%. The investors who held through those crashes, who kept buying during the worst of it, ended up wealthier than they would have been if the crashes never happened. They bought shares at discounted prices that subsequently recovered, and then some. But holding through crashes requires preparation. You have to decide in advance that you won't sell during market downturns. You have to understand intellectually, before the emotions hit, that crashes are normal, recoveries are reliable, and selling at the bottom is the worst possible move. Some practical tips for maintaining this discipline. Keep enough cash in savings to cover 3 to 6 months of expenses. This emergency fund means you won't be forced to sell investments during a downturn to cover an unexpected expense. Invest only money you won't need for at least 5 years. preferably 10 or more. Short-term money belongs in savings accounts or short-term bonds, not stocks. Don't check your portfolio frequently. The more often you look, the more often you'll see losses, and the more tempted you'll be to react emotionally. Remember that unrealized losses aren't real losses. If your portfolio drops 20% but you don't sell, you haven't lost anything. You still own the same number of shares. Those shares will recover if you wait. Have a written investment plan that specifies what you'll do in various scenarios. When the market drops 20%, I will continue my automatic investments. When the market drops 40%, I will continue my automatic investments and consider investing additional funds if available. Writing this down in calm moments helps you follow through during stressful ones. Consider your risk tolerance honestly. If a 50% decline would cause you to sell everything, you need more bonds in your portfolio, even if that means lower expected returns. The best portfolio is not the one with the highest theoretical returns. It's the one you can actually stick with. Now let's put this all together into a practical sequence. Step 1. If your employer offers a 401k with a company match, contribute at least enough to get the full match. A typical match might be 50% of your contributions up to 6% of salary. That's an immediate 50% return on your money. Free money should never be left on the table. Step 2. Build an emergency fund of 3 to 6 months of expenses in a high-yield savings account. This protects you from having to sell investments during emergencies or market downturns. Step 3. Contribute to a Roth IRA up to the annual limit if you're eligible based on income. The tax-free growth and tax-free withdrawals in retirement are extraordinarily valuable, especially when you're young and your marginal tax rate is likely lower than it will be later. Step 4. If you have access to an HSA through a high-deductible health plan, max it out. The triple tax advantage makes HSAs more powerful than either traditional or Roth retirement accounts. Step 5. Return to your 401k and increase contributions toward the maximum if you can afford to. Step 6. If you've maxed all tax-advantaged accounts and still have money to invest, open a taxable brokerage account and continue investing there. Within each account, keep it simple. A single S&P 500 or total market index fund is sufficient for most people. Add international exposure and bonds if you want, but don't complicate things unnecessarily. The exact allocation matters less than the contribution. Someone investing $1,000 per month in a suboptimal portfolio will crush someone investing $200 per month in a perfect portfolio. Finally, let's address some common beginner mistakes. Mistake 1. Waiting for the right time to start. There is no perfect time. There is only now or later. And now is always better than later because time is your greatest advantage. Mistake 2. Trying to pick individual stocks before understanding the basics. Index funds are boring. They don't give you stories to tell at parties, but they reliably build wealth without requiring expertise or luck. Master the fundamentals before attempting anything more complex. Mistake 3. Checking your portfolio too frequently. Daily monitoring leads to emotional decision-making. The best investors are often the most passive ones. Set it, forget it, check it quarterly at most. Mistake 4. Selling during market downturns. Every significant market decline in history has been followed by a recovery and new all-time highs. Selling locks in losses and prevents you from participating in the recovery. Mistake 5. Paying high fees. The difference between a 1% expense ratio and a 0.03% expense ratio is hundreds of thousands of dollars over a lifetime. Use low-cost index funds. Mistake 6. Failing to increase contributions over time. Your first contribution amount should not be your last. Each raise, each debt payoff, each lifestyle adjustment should flow to investments. Your savings rate should grow with your income. Mistake 7. Treating investing as optional. Investing isn't what you do with money left over after everything else. It's a non-negotiable expense like rent or food. Pay yourself first, then live on what remains. That's the foundation. If you do nothing else after watching this, if you take one action, open a brokerage account, set up automatic monthly investments into a low-cost S&P 500 or total market index fund, and don't touch it for the next several decades, that single action, maintained consistently, will put you ahead of 90% of Americans. You won't need to be smarter than everyone else or luckier than your peers. You'll simply be doing the thing that most people know they should do, but never actually do. The gap between knowing and doing is where wealth dies. Close that gap. Start today. Your future self will thank you in ways you can't yet imagine.